Explainer. Today, we're taking a high-octane, top-down look at exactly how overnight geopolitical tremors are literally feeding directly into today's technical setups. Look, for financial market participants, the macro funnel is moving incredibly fast right now. And yesterday's headlines? Well, they're already printing hard support and resistance levels on the charts you're trading right this second. So, let's get right to it.
Okay, let's dive into this. $110. Brent crude is holding firmly above this level, and right now, oil is the undisputed main character of the global market. It's driving inflation fears, it's dictating terms to central banks, and it's casting a massive shadow over every single asset class. I mean, when oil moves like this, driven by massive supply disruptions, everything else just reacts.
Section 1. Global Macro and Geopolitics. To really grasp why crude is acting like a massive global tax hike, we have to look at the Middle East, which, let's be honest, currently resembles a highly volatile geopolitical chessboard. Right now, every single strategic move is spilling oil. We're seeing massive structural shifts happening all at once. On one side, you have a historic realignment. The UAE is exiting OPEC after nearly 6 decades. They're basically choosing flexibility over fraternity, backed by a U.S. swap line and a heavily fortified security arrangement, including an Israeli Iron Dome presence. Now contrast that with the immediate physical shock on the other side. The Strait of Hormuz remains effectively shut. That is disrupting roughly 20% of global oil flows. So this isn't just some localized conflict, it's a fundamental restructuring of global alliances colliding head-on with a massive choke point blockade.
And the diplomatic drama? It's moving at breakneck speed. Donald Trump has publicly declared Iran to be in a state of collapse. Meanwhile, Iran has reportedly asked for the lifting of the U.S. blockade, actually proposing to delay nuclear talks, a sequence the U.S. seems, well, quite unimpressed by. At the same time, Iran's foreign minister just met with Vladimir Putin, who pledged support and kind of hinted at Russia acting as a broker. We're also seeing Iran communicate these non-negotiable red lines regarding its nuclear program in Hormuz through Pakistan. Basically, we're watching rigid posturing and high-level meetings keep the geopolitical risk premium absolutely sky-high.
So, how is the global market digesting all of this? Equities are definitely wobbling. The Nasdaq Composite just logged its sharpest drop since March. Tech took a direct hit as AI enthusiasm hit a serious speed bump, and that was largely driven by concerns over OpenAI missing its growth targets. Semiconductor stocks followed right along, with the SOX index dropping 3.6%. And if you're looking for a safe haven, well, gold is currently hovering below $4,600, really getting pressured by expectations of higher for longer interest rates despite all this geopolitical stress.
Section 2. Data Pulse and the Fed.
Let's funnel down from the geopolitics for a second and look at how central banks are reacting to this sudden sharp inflation spike. And this brilliantly illustrates the exact predicament they're in. ECB President Christine Lagarde called it a layer cake of shocks. They are completely pinned. Just yesterday, we saw Eurozone inflation expectations jump to 4.0%. That's the biggest rise since early 2022. Meanwhile, in Japan, the BOJ cut growth forecasts while actually raising inflation projections in a classic stagflation cameo. Central banks are bracing for consumers expecting expensive everything.
All right, for traders, here is your rapid-fire checklist for today's Data Pulse. In Europe, keep a close eye on Spanish and German CPI prints, along with bond auctions to gauge inflation persistence. Over in the US, we've got durable goods, housing, trade balance, and inventories. And remember, growth signals matter a whole lot more now than inflation is roaring back. We also have the Bank of Canada rate decision, and of course, the big one, the FOMC rate decision.
But here's the paradox. On literally any other day, the FOMC decision would be the undisputed main event, but not today. As noted in our source analysis, it's almost a side event. The Fed is widely expected to hold rates at 3.50 to 3.75%. The real focus? It's entirely on the messaging. This is likely Jerome Powell's final press conference as chair, with Kevin Warsh waiting in the wings to take over. Markets really want to know if Powell is going to lean into stagflation concerns and how Warsh's potentially tighter balance sheet stance will impact things going forward. The hold is obvious. The geopolitical overshadowing is what makes this whole thing so complex.
Section 3. Major currencies and technicals.
Let's see how this builds into the actionable technical setups. We're going to marry these soft macro catalysts with your hard trading levels, starting with the dollar index. The soft point driving this is the 10-year Treasury note, which just climbed to a one-month high of roughly 4.35%, mostly due to fears over the Middle East standoff. But despite this, the technical structure remains a sell-on rise. You're looking at resistance right at 99.00. Key supports are layered below in 98.60 and 98.17. Unless the Fed statement throws out a massive curveball, this tactical view absolutely holds.
Moving over to USD, the market is pricing in a hold at the upcoming meeting, sure, but it fully expects a crucial June rate hike that could take the ECB deposit rate to at least 2.5% by year-end. Because of this hawkish trajectory, the structure for the pair remains a buy on dips. Your immediate support is down at 1.1656, with resistance targets sitting overhead at 1.173 and then 1.1780.
For the British pound, the macro backdrop is intense. The UK 10-year government bond yield is really toying with that psychological 5% handle. The Bank of England is widely expected to hold right into a severe supply shock, all while having to absorb over $250 billion of annual issuance. But despite the squeeze, the technical setup here is also a buy on dips. You'll want to look for strong support at 1.3450, with resistance capping the top at 1.3558.
Now, the crucial point on the yen is that Bank of Japan's hawkish 6-3 vote to hold rates. 3 dissenting members favored a hike. That is the largest dissent count of the current cycle. Governor Ueda gave some kind of vague guidance which dampened initial yen strength, and that's keeping resistance firmly in play. The tactical view is buy on dips, with support at 158.93. Keep a very close eye on the 159.77 resistance, though. If that breaks, the door swings wide open to 160.55.
Section 4. India Equities and Rupee.
All right, let's bring this macro funnel directly to the Indian markets, where global crude oil realities are colliding head-on with local regulatory updates. Indian equities slipped yesterday, essentially because $110 crude played the role of a massive domestic tax hike. But the specific pain point, that was in the financials. The Reserve Bank of India rolled out its final credit loss norms, which nudged provisioning higher, especially Stage 2. The banking index dropped 1.5% as the RBI gently reminded PSU banks that prudence is absolutely mandatory right now. However, it wasn't all dark skies. Industrial production did grow 4.1% year-over-year, which is definitely a solid silver lining.
Looking at the Nifty 50, the index fell 0.40% to 23,995. But interestingly, broader markets actually outperformed, with mid and small caps showing real resilience and edging up. The overarching structure remains a buy on dips. You've got resistance up at 24,344, but pay very close attention to your support zone at 23,874, followed by 23,861. A daily close below that 23,861 level that completely invalidates the buy on dip structure.
Finally, let's talk about the rupee. USD-INR weakened to a near one-month low, closing at 94.54. It's being heavily pressured by the 1-2 punch of persistently high crude oil prices and sustained hedging demand from local importers. The structure here is also a buy on dips. Resistance has now moved up to 94.92, while your tactical support levels are resting down at 94.51 and 94.06.
We have covered a tremendous amount of ground today, from the restructuring of global oil alliances and a blocked Strait of Hormuz all the way down to the exact support levels on your trading screens. With oil prices completely dictating the global narrative right now and central banks pinned by stagflation fears, the macro environment is incredibly fragile. So I'll leave you with this absolutely critical risk management question. Are you positioned for the next layer of shock? Thanks for joining me on this explainer. Keep your eyes on those charts, respect your levels, and I'll catch you next time.